Put together a portfolio that I think is one of the cheapest ways of investing in the global market. It consists of 6 ETFs, all from Vanguard to keep it simple, and they should all be available on most investing platforms. If you've watched this channel before, you'll know I'm a big fan of a global index fund. It's the most passive approach you can take with investing. It's an all-in-one product. But the benefits of creating your own DIY portfolio is it's going to save you money on fees, which means more of those profits are going to be reinvested back into your portfolio, growing your pot over time. It's also going to allow you the flexibility to change the weights of the fund as you see fit if you wanted to take a view that a certain area was going to outperform. But more on that a little bit later. First, let's have a look at what kind of level of fees we're talking about. So let's look at the Vanguard FTSE All World ETF. So this is a global ETF from Vanguard, which has an ongoing charge of 0.22%. Now let's compare that to one of the most popular ETFs out there, the S&P 500. So this is Vanguard's version of it, and that has an ongoing charge of 0.07%. Now, because we're dealing with relatively low fees, that may not seem like that much of a difference, but actually when we compare the two, that's more than 3 times more expensive to invest in a global fund than it is the S&P 500. And over a long period of time, that could make a substantial difference to your portfolio. Now, when creating our own DIY portfolio, we need to look at the breakdown of that global fund and ensure that we've got the right regions and the right weights so that we can capture the same exposure to get similar returns. The global fund covers most of the world and it's weighted, so the larger the stock market, the larger the weighting it has in the fund. So for example, the United States is the largest in the world, and that's reflected in its weighting in the global fund at 62%. So to create our portfolio is a case of finding an ETF to match each part of the world. When it comes to choosing the ETFs, there's literally thousands out there to choose from. I've gone all from Vanguard, mainly just to keep it simple, but also because they're one of the biggest players in the market. But if you're willing to do a little bit more digging, you may even be able to find this cheaper than what I've done it for. Here's what I've chosen and the weights that we need to use to get one of the cheapest DIY global funds. The first one is the biggest one, and we're going to start with the FTSE North America UCITS ETF. A lot of people might be tempted just to use the S&P 500, but it's important we don't forget Canada here. This fund currently contains 586 stocks and it has an ongoing charge of 0.1%. For this fund, we're going to use a weighting of 64.5%. Next, we've got the FTSE Japan UCITS ETF. Now, when it comes to looking for an ETF for Japan, you've got a couple of different options, and you'll see this when you start to search for it. If you wanted to, you could keep it simple and just simply do a developed Asia Pacific fund, which includes Japan. But for this portfolio, I'm going to do it separately because it is slightly cheaper. So I'm going to do Japan on its own, and then I'm going to do a developed Asia fund without Japan later on. This Japan ETF currently invests in 487 stocks and has an ongoing charge of 0.15%. And the weighting of this fund is going to be 6% of the portfolio. Next, we have the UK, and we're going to use the FTSE 100 UCITS ETF here. Again, we do have a similar approach where we're going to separate UK from Europe. You can, if you wanted to, do a European fund that includes the UK, but it will be slightly cheaper to do this separately. So for this portfolio, I'm going to use the UK on its own, and for that, I'm going to use the FTSE 100. This ETF currently invests in 102 holdings and has an ongoing charge of 0.09%. And for this fund, we're going to use a weighting of 3.6%. Now let's make up the rest of Europe, and to do this, I'm going to use the FTSE Developed Europe excluding UK UCITS ETF. This currently invests in 429 holdings and has an ongoing charge of 0.1%. The weighting for this fund in the portfolio is going to be 12%. The fifth fund in our portfolio is going to be the FTSE Emerging Markets UCITS ETF. An often overlooked part when it comes to investing, but an area where there's a lot of potential. This ETF is currently invested in 2,237 holdings and has an ongoing charge of 0.22%. This area is predominantly why a global index fund is as expensive as it is. You'll notice the ongoing charge for this ETF is exactly the same as the global ETF we looked at the start. And this is where by splitting them out, we can save that money on the fees. The weighting for this ETF is going to be 10% of the portfolio. And the sixth and final ETF in our portfolio is making up the rest of Asia. So this is the FTSE Developed Asia Pacific excluding Japan UCITS ETF. This fund is currently investing in 365 holdings and has an ongoing charge of 0.15%. The weighting for this fund is going to be 3.9% of the portfolio. I have had to slightly alter some of the weightings just to make sure it adds up to 100%. But there is our portfolio with our 6 ETFs, all with their ongoing charge and the weightings that we're going to put into the portfolio. The average fee across this portfolio is 0.16%, but more importantly, the weighted average is 0.14%. That's 0.08% less than the global ETF we looked at the start. Now, there's a couple of things to consider when creating a portfolio like this, and specifically the platforms that you use to do so. The main thing is going to be rebalancing. Because the global economy is obviously constantly changing, you're going to have to rebalance your portfolio to reflect the changing market caps and the weightings in the fund. That means the regions that outperform, you're going to have to sell, and you're going to have to buy more of the underperforming ones. Platforms like Trading 212 and Invest Engine have a simple rebalancing feature. So you can set up your portfolio with the percentages that you want. And then over time, say a year later, they've slightly changed. You can then bring them back to the selected weightings that you had at the start. They may have also changed in the global ETF. So it may not just be a case of bringing them back to what they were at the start. It's a case of constantly keeping up to date with where the global markets are. Those two platforms also don't have any charges when it comes to buying and selling of the ETFs. So if you're not using those two, just make sure you're aware of any extra charges that you might be charged when it comes to buying and selling, because some platforms do just treat ETFs exactly the same as single stocks. Now let's assess whether this is actually worth it and revisit those two benefits that we mentioned at the start. The main one being that this is going to save us money in the long run. Let's look at a real life example. Let's look at a 30-year investing period comparing our 6 ETF portfolio versus your typical global ETF. We're going to use an initial investment of £1,000. We're going to assume a growth rate of 10% just to keep it simple. And we're also going to assume that we can contribute £250 every month. Now, if we left this to compound, at the end of that period, we would have £584,959.38. Now, if we take the difference in ongoing charge from a typical global ETF, which is at 0.22%, and the ongoing charge that we've calculated for our portfolio, which is 0.14%, then there's a difference of 0.08%. So what I'm going to do to the growth rate is simply reduce this by 0.08%. Now, if we run the same test using a growth rate of 9.92%, we now get a future investment value of £574,939.22. That's £10,000 difference. Now, that might not seem like that much of a difference, but remember, this is just on an initial amount of £1,000 and £250 per month. I haven't considered that we could increase this monthly amount. So if you're able to invest more than that, then that difference could be even more. Breaking that £10,000 down, that's around £333 per year, or around £28 per month, which I'm sure most people wouldn't mind having that little bit extra in their portfolio just from adding this extra step. And the other part to creating your own DIY portfolio is having the control over those weightings. We use the weightings based on what a typical global FTSE All-World ETF currently has. But of course, over time, you can assess the performance of each region and potentially change that to your liking. Now, I don't recommend this for most people. This is definitely more for the active investor. And actually, research shows that the more active we are with our investing, the actual higher chances we have of making less money. But it could be that as you start to see a certain area outperform, because you'll see that in the data when you come to rebalance, you might not want to rebalance straight away, because if a certain area, say for example, emerging markets start to outperform some of the developed areas, you might want to ride that out. Just because it's outperformed for 1 year, you might want to let that run for another couple of years. Again, you are starting to make an active decision in the markets, so you have to be aware that you do take on a little bit more risk in doing so. But if you want to take a little bit more interest in the markets, then that of course is an option for you. And of course that is an option. So you can just rebalance exactly the same way than your typical global ETF will do it. So then you get a similar exposure, which then means you're going to get similar performance, but actually your performance is going to be slightly more because you've got less fees coming off the top. Let me know, have you tried something like this? If you got some different funds in there, like I said, if you're willing to dig around a little bit more, you may even be able to find this a little bit cheaper. I'll be really interested to hear your opinions, whether you think this is worth it, that extra step and the extra time that you might need to put into this in order to rebalance. Is that small difference in fees? Is that worth it? Let me know in the comments down below. I hope you found that useful. Drop it a like if you enjoyed it, subscribe if you're new, and I'll catch you in the next one.